Welcome to Mysteel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. Today, we look beyond the latest ceasefire headlines to focus on what really matters: the real conditions of the Strait of Hormuz, shipping access, insurance risks, and sustained energy supply uncertainty. Joining us today is Liao Na, Chief Consultant of Energy Policies.
Thanks for having me. It is great to be here again.
Let us start with the headline development. Recent temporary ceasefire arrangements between the United States, Israel, and Iran have not brought about tangible improvements in shipping or de escalation, while China's independent refiners have received additional crude import quotas. Many people are asking whether this means the situation is turning and whether the worst phase is already behind us. How do you read it?
I think a statement about temporary safer navigation does not mean full reopening of the Strait of Hormuz, and it certainly does not mean a return to pre conflict conditions. The key variable for the oil market is not whether there is a ceasefire in name, it is whether vessel transit rates can recover, whether energy infrastructure remains secure, and whether the commercial conditions for shipping can normalize. That is why my conclusion is that the conflict has entered a fragile pause that could break at any time, but the broader crisis has not ended.
So, in your view, the headline itself is not enough to change the market narrative.
Yes, exactly. I think that is the right starting point. The headline matters, of course, but the market will probably focus more on whether ships can actually pass, how quickly they can move, what level of risk remains, and whether insurance support comes back. Until those conditions improve more clearly, it is probably too soon to say the situation has materially improved.
Then, let us look first at the issue of implementation. Why are you cautious about the actual effectiveness of this ceasefire?
The first reason is Iran's decision making structure. On paper, a ceasefire message may come from the government side, but in practice, the group with the strongest influence over the strait is the Revolutionary Guard. That matters because the question is not simply who makes the statement, but who controls enforcement and who benefits most from the current arrangement. In Iran's internal power structure, the Revolutionary Guard is not only a military force, it is deeply embedded in political and economic decision making as well. It controls a significant share of national income, and according to the assessment in the source material, toll like revenue from straight passage is also closely tied to that system. So, from a practical perspective, there is good reason to be cautious about how binding or effective a ceasefire commitment really is if the main beneficiary of the current control structure has limited incentive to fully reopen the strait.
So, the core issue is that political signaling and operational control are not necessarily the same thing.
Yes, that is right. A political statement does not automatically translate into operational execution. That gap is exactly why the market should be careful about assuming that a short term ceasefire means the crisis is being resolved.
And beyond politics, you also mentioned market mechanisms. What is the most important one here?
The key mechanism is insurance. Even if the political message is that navigation is becoming safer, the market will look closely at whether insurance coverage can be restored. That is the real commercial threshold. A vessel may only earn a limited freight margin on a voyage, but the value of the ship and cargo can run into the hundreds of millions of dollars. If drones remain a threat overhead and mines remain a risk below the surface, insurers are unlikely to resume coverage quickly. And without insurance, most ship owners are unlikely to send vessels through the strait. And this is why historical comparison matters. Even in the Red Sea case, after the Houthis reduced their direct disruption, a full normalization of shipping still took several months. In the case of Hormuz, where the underlying control structure has not fundamentally changed, expecting a quick and full recovery is not realistic.
So, when people hear the word open, that can be misleading.
Yes, I think open here is unlikely to mean a return to pre war free passage. A more realistic interpretation is a limited and conditional reopening, closer to a paid access model where some ships can pass under control, but overall throughput remains far below normal. Iran has since reversed partial reopening and retightened controls.
Let us turn to the intentions of the major parties. Why do you think the situation still has a long tail risk?
Because when we look at geopolitical crises, it is important not just to listen to what each side says externally, but to assess what each side wants internally. For Iran, as I mentioned, there is limited incentive for the Revolutionary Guard to fully restore free passage. For the United States, it has the military ability to push much harder to reopen the strait. But the question is whether it is willing to absorb the political, fiscal, inflationary, and military costs of doing so. The US has since stepped up naval pressure and port interdictions. And for Israel, the source material makes a very clear point that there is little domestic incentive for a clean and durable stop because the political cost of ending the conflict could be high. So if we look across the three parties, the one with the clearest interest in stepping back is the United States. But that alone is not enough to guarantee a stable de escalation.
And how about the broader international response?
That is another reason the market should not assume a quick resolution. There has not been a unified international front against Iran. In fact, some countries outside the Gulf benefit from the disruption because trade routes shift, freight patterns change, and alternative exporters gain market share. Even among US allies, there has been no decisive collective intervention. Iran is now structuring differentiated access for friendly countries and pushing for non dollar payment. China, meanwhile, has influence, but the current judgment is that it has not yet reached the point where it must intervene forcefully because China's domestic economic and energy conditions remain manageable for now. Other Asian buyers either lack the capability to shape events or they simply pay the added cost and keep moving cargo where possible.
So the broader takeaway is that the strait may be less closed than before, but not genuinely normalized.
Yes, exactly. That is the main point. The strait may become more passable than during the most acute stage of disruption, but that is very different from saying it has returned to normal. The more likely scenario is limited access, continued friction, and a situation that remains highly vulnerable to renewed disruption.
Let us move from the strait itself to actual supply. What do the shipping and import data tell us so far?
The Strait of Hormuz has remained under tight restrictive control since early April, with repeated disruptions and no return to normal shipping. GL Consulting expects recurring disruptions with limited near term relief, with transit rates likely to remain below 10% in April and only partially recover to 20% to 50% in May to June. That suggests the ceasefire did not address the core contradiction behind the shipping blockade. At the same time, crude exports from the region have already fallen sharply. Middle East supply disruptions have tightened global crude availability significantly, and normal shipping patterns have not resumed.
So the impact is no longer just about short-term shipping disruption. It is also feeding into China's broader supply and refining outlook.
Yes, exactly. And that is also why policy response matters. To secure China's domestic oil product supply, China has continued its export control policy on refined products through April. This policy was first introduced on March 4th and has no clearly defined end date, so its duration remains linked to the broader Middle East situation. At this stage, only bonded jet fuel, bonded bunker fuel, and oil products supplied to Hong Kong and Macau are exempt. Although China has granted limited export exemptions to some neighboring friendly countries in April, gasoline and diesel exports are still expected to remain low overall.
And what about gas and LNG? Has the outlook changed there as well?
Yes, the gas outlook has also become more cautious, but for a slightly broader set of reasons. On the demand side, the macro backdrop remains soft. China's 15th five-year plan continues to prioritize electrification, hydrogen, and zero carbon infrastructure, which structurally caps traditional chemicals demand. At the same time, natural gas downstream demand remains weak. In January and February, retail sales of petroleum products, including gas, fell by 9.7%, marking the first contraction since 2020. The property downturn is also weighing on demand, while some support is coming from services consumption and infrastructure investment. So, demand growth remains uneven, with weaker performance in sectors such as non ferrous, metals, and chemicals continuing to suppress industrial gas consumption.
So the demand side is not giving much support.
That is right. And price is another constraint. Upstream oil and gas prices are being pushed higher by geopolitics rather than by stronger downstream demand, which in itself can weigh on consumption. At the same time, rising battery prices are reinforcing EV competitiveness relative to LNG transport. So even though some segments such as services and parts of manufacturing are improving, the overall gas demand picture remains quite restrained. And on the supply side, China's domestic production has been revised higher. GL Consulting now expects China's domestic gas production to reach 264.3 billion cubic meters in 2026, up 3.5% year on year, supported by shale gas, coal bed methane, and coal to gas. April production is estimated at around 21.9 billion cubic meters, up 4.4% year on year, with a slight month on month decline, and May production is expected to recover.
And how does that translate into the overall demand and import outlook?
GL Consulting has lowered its 2026 gas demand forecast to 429.4 billion cubic meters, and the growth that remains is expected to come mainly from transport and power rather than from a broad based industrial recovery. With the market also moving into the shoulder season, near term demand is likely to stay soft. On the import side, Middle East tensions and disruption in the Strait of Hormuz are tightening LNG supply and keeping prices elevated. GL Consulting now expects China's total gas imports to edge down slightly to 175.2 billion cubic meters in 2026, with weaker LNG imports partly offset by pipeline supply.
So if we put that together, what does this mean for China's broader market response?
I think it means China is responding in a relatively structured way. It is not treating this as an immediate supply collapse. It is treating it as a prolonged risk event that needs to be managed through buffer stocks, more flexible procurement, lower refinery runs where necessary, and greater use of domestic and contract gas supply. At the same time, elevated oil prices and Middle East supply disruptions are driving deep structural change across Asia's petrochemical sector. Over 60% of Asia's seaborne naphtha imports depend on the Middle East, and recent tensions have caused severe feedstock shortages, pushing operating rates in Japan, South Korea, Southeast Asia, and South Asia to historic lows. China's propylene self sufficiency has risen above 93%, and its explosive capacity growth is reshaping the regional supply demand structure.
Before we close, what do you see as the one key takeaway for our listeners?
I think the key takeaway is that a temporary ceasefire does not necessarily mean the situation has been fully resolved. What matters now is not the wording of the agreement, but whether shipping access actually improves, whether insurance returns, and whether the main parties have the incentive to push the situation toward genuine de escalation. Right now, the evidence suggests that the strait remains vulnerable, throughput remains far below normal, and the broader conflict is moving into a more prolonged phase. In other words, the battle may have paused, but the war has not ended.
So the broader message is that this is not yet a turning point. It is still a market environment shaped by constrained transit, slower regional exports, and a high level of geopolitical uncertainty.
Yes, exactly. I think that is the main point.
And for those who would like to follow these developments in a more structured and forward-looking way, GL Consulting acts as a China decoder, helping turn complex policy and market signals into clearer, decision-ready insight global energy and chemicals professionals. Reach out to us for a sample issue of China Policy Perspective for regular analysis of China's policy direction, energy security priorities, and the broader market implications of geopolitical disruption. Thank you for joining us today, Liao Na, and thank you to our listeners for tuning in. We look forward to having you with us again in the next episode.